Cash flow forecasts. You see, in financial reporting, you prepare a cash flow statement. That cash flow statement in financial reporting, that is actually the cash flow statement for the past year. I mean, the year which has already completed. So that refers to the past cash flows. Here in this topic, when we say cash flow projections, we'll call it cash flow forecast. So this is the cash flow statement we make for the next year, for the upcoming year. For example, if we are sitting today by the end of 2024, we will be making our cash flow forecast for the next year, which is 2025. So it will be made month by month, like January, February, March, April. How much are you expected to receive from sales revenue, cash sales? How much are you going to receive from credit sales? Because credit customers, they pay 30 days or 60 days later. When do you have to pay to your suppliers and salaries and your cash outflows? And then also your investment in purchase of non-current assets, cash outflows. When are you going to pay your taxes, or you have to return back some loans? So everything will be considered for the next year. And you want to see that, okay, end of January, how much cash I will have surplus or shortage, February, March, April, May, June. So all is forecast, all are estimates. They are not accurate, but they are close to, you try to do your best so that they become as close as possible to the real numbers, which are supposed to happen. So when you have next 1 year cash flow statement month by month with you, you can see that what is your cash situation, when do you have cash shortages, in which months you will have cash shortages, in which month you're expected to have cash surplus, what to do with cash surplus, and how to manage the cash shortages, and so on. So this is in advance. And this is made 1 year, prior to, how to say, the beginning of the year. We call it cash flow forecast. So cash flow budgets. They should include both revenue and capital flows. Revenue means from your operations. So revenue flows, you have like, sales revenue, sales, the cash coming in from sales. Revenue outflows are expenses which you pay for operations. And capital flows are when you buy or sell non-current assets. So if you sell non-current assets, you receive cash. If you buy non-current asset, you have to pay cash, and so on. Capital flows. Careful attention needs to be paid to the timing of receipt or payment when you have to. That's important because it is possible that you sell goods in the month of January, but your sales are, let's suppose, $100,000 in January. But you are not going to receive all of 100,000 in January, because your customers, some of your customers, they will pay in the same month, some will pay in the next month, and some will pay maybe after 2 months. So it is possible that your sales composition is like 30% cash, another 30% pay in 30 days, another 30% pay in 60 days. So if this is, another 40% pay in 60 days. If this is a situation, then 100,000 sales in January, you will receive 30% of 100,000 in January, 30% in February, and 40% in March. So the timing of cash flow is very important. They should be based on the budgeted statement of profit or loss and statement of financial position. Of course, cash flow statement, you make it after P&L and balance sheet. So first you make your profit and loss based on sales and expenses and so on. And based on that, you make your cash flow forecast. Essentially, we are producing a bank statement in advance. Typical layout is like this: January, February, March. I've only taken 3 months. It is April, May, June, July. It actually should be for 12 months. You have cash sales here from credit customers, total receipts. Then you have payments, suppliers, wages, other expenses, tax, dividend, total payments, cash opening balance brought forward from the previous period, net of receipts and payments, and this is cash carried forward to the next period. And this cash carry forward to the next period, it moves up here and then it moves up here, okay? So it goes to the next period as well. So correct timings of receipt from customers and payments to suppliers are essential, because if you purchase goods in January, you might not be paying them in January. You have 30 days credit period. So January purchases are paid in February, February purchases are paid in March, and so on. In the exam, these calculations are not difficult, but they are repetitive, and initially care is needed to get started correctly. Yeah, it's not a difficult actually questions. You are expected to receive you to see such type of questions, repetitive, but you have to be careful that you put the cash flows in the correct months. Okay, so a careful attention that what percentage I receive in the same month, what percentage I receive in the 30 days or 60 days or 90 days, and so on. It is essential to provide clear workings, both to help your accuracy and so that a marker can follow what you have done. Simple cash flow expect to try. What cash inflows will arise for January, February, or March from the sales figure and other information below. So sales, okay, so these are a little bit moved. It should be below here. Let me try if I can correct it. Okay, now it looks better. So October is 100, November is 120, December is 160, January is 80, February 90, March 100. These are your sales figures, okay? Now, what next? By the way, we have to find out cash inflows, only inflows, and we have to find out for January, February, and March. So January, February, and March cash inflows. These are sales. These are not cash inflows. Now, see the instructions. It says that customer pay as follows: 30% after 1 month, 60% after 2 months, 5% after 3 months, and 5% never received, which means 5% is bad debt. So what does that mean? It means that this, let's suppose this last month, if I speak to, so this is 100. 30% after 1 month. So 30% will come here, okay, which is like 30. And this is the month of April. 60% after 2 months. 60% will come here, which is May. And that is actually 60. And 5% after 3 months. 5% here, which is the month of June, which is 5. And this 5 you will never receive. So the sales which you make in March, you don't receive cash in March. The March sales cash you will receive in April, May, and June, 30, 60, and 5. So we are, of course, not interested in April, May, and June. We are interested in January, February, and March. So in January, February, and March, actually, you will receive the cash from the previous months. Okay. So from the previous months, for example, this December cash, 30% will come here, 60% will come here, and 5% will come here. So January cash is coming from December. This November, something is coming. So let me change some colors. So November, 30% will come in December, 60% will come in January, and another 5% will come in February. Nothing in March. For October, you again receive 30% in November, 60% in December, and 5% in January. So January is actually receiving a little bit from here, a little bit from here, and a little bit from here. 5% of this, 60% of this, and 30% of this. 1 month, 2 months, 3 months. So that's why I said that in the beginning, that you need to be a little bit more careful in deciding the timing of cash, okay? So let me show you how do you do it in a more structured way, okay? So what we can do that we can make a table. So it says 30% after 1 month, 60% after 2 months, 5% after 3 months, and 5% never received. So it is always good idea to make a table. So October, November, December, January, February, March. So this October, it comes here like, from October, it is 5%, 30% after 1 month, 60% after 2 months, and 5% after 3 months. So 3 months is January. So from October, you receive only 5%. November, you receive 30% in December and 60% in January. So $120 into 60%, 72. December, you receive 30% in January, then you receive 60% in February and 5% in March. So if you see December, you receive 30% here, okay? And then this comes from in January. So the January cash flow will be 80, 42, 72, 5, 100. And so this is actually the sales. So cash flow is this 48, 72, and 5. It makes 125. So 125 is the total of these three numbers. Forget about 80. This is not the cash flow. This is the sales. Okay. So same pattern you will make the February and March. For example, this 24, where it is coming from? It is coming like 30% of January will come in February. So 30% of 80 is 24. Then 60% of January will come in March. So 80 into 60%, it comes here. Here, 48. 8 times 60, 48. This 48 is actually January, second month. So first month, second month, third month. First month, second month, third month. Okay. So this 80 for January, $30 come here, 30%. 60% comes there. And 5% will come in April, but April we are not making, so it does not appear. If you want to see this March, this is 27, where it is coming from. So this is 30% of this. Then this 48 is coming from January, 60%. This 8 is coming as 5% of December. 160 into 5, it comes here. So you have to be careful in making the structure. Otherwise, it is not very difficult. It's only about, being careful where I'm going to receive the cash. For efficiency and accuracy, work horizontally once you have decided. Why do we say horizontally? Because January, February, March, April, you can make these columns and it will be easy to do. Which amounts appear where? Not every aspect of the statement of profit or loss amount will have cash flow consequences. Because of course, we said that cash flow statement we will make from profit and loss and balance sheet, but whatever goes into profit and loss not necessarily comes in the cash flow statement because there are non-cash items. Remember, cash flow statement is only about cash. But your profit and loss statement, your income statement, it does have non-cash items. For example, depreciation. It does not appear in the cash flow statement. Maybe you have some accrued expenses, accrued income. That does not go into the cash flow statement. Maybe you have some provisions for bad debts and so on in expenses. It does not go into the cash flow statement. So similarly, SOFP items will affect the cash flow forecast. So you have to see that, for example, in SOFP, the same thing. You might have asset revaluations. It is not cash flow item. Okay. You might give bonus shares. It is not cash flow item. So you remember the same concept that cash flow item will include only those items which have real cash coming in or going out. Which of the following will appear on a cash flow statement? Increase in receivable provision. It is not cash flow item. Okay. No cash flow impact. Purchase of non-current assets. Yes, it will because you are giving cash. Depreciation, not cash flow. Taxation, if you are giving tax in cash, of course, yes. Accruals, no. Because accrual, we are not receiving or paying cash. We are just booking asset or liability. Yeah, so this is here. Dividends paid. If dividends have been paid, yes, it is. If it is declared, dividend declared means that you have made an announcement that we are going to give dividend, but you have not given it yet. So dividend declared does not have cash impact, but dividend paid has cash impact. Use of opening SOFP figures. Opening statement of financial position. If you have done cash flow statement before, you know that how do you make cash flow statement, okay? You need 2-year balance sheet and 1-year income statement. For example, if I want to make my cash flow statement for 2023, if I need to make cash flow of 2023, what I need my SOFP and I need two SOFP, 2022 and 2023. And I need my P&L for 2023. So I need 3 statements, 3 pieces of paper in front of me. This year income statement, this year balance sheet, and last year balance sheet. We say use of opening SOFP figure. Opening SOFP figures you will take from here. Only then you can find out that how much cash have you received from your customers or paid to your supplier. I don't want to go into a lot of detail here because we are not going to make the cash flow statement as such, but just for the sake of curiosity here, or just to complete this discussion, opening SOFP figure, if I tell you in your P&L that how much cash have you received from your customers? You cannot tell me because it says sales 100,000. You don't know how many customers have paid, how much they have paid, and so on. It is just sales number. But I say that cash from the customers, cash received from customers, how much it is, I don't know. Okay, then let's see our SOFP. If I see my SOFP for 2023, it says receivable. This is my 2023. Receivables are 25,000. So it says that 25,000 you have closing receivable. So how much cash you have paid, received from customers, still you cannot say, because you cannot say that 100,000 I have sales, 25,000 I have receivables, 75,000 customers paid. No, because there were some opening receivables as well, opening balances. So you say, okay, tell me the last year balance sheet. How much were receivables in the previous year? Previous year receivables were 30,000. You take opening balance, SOFP. Now you can say that my opening receivables were 30,000. I made sales in this year 100,000. So my total receivables should have been 130,000. This is how much it should have been. Okay. My opening receivables were 30. Customers owed me 30,000. Then 100,000 goods, I sold them further. So I am supposed to receive 130,000. But what I see that my closing receivable from this year balance sheet is only 25,000. So instead of 130,000, I have closing receivable only 25,000. Where is the remaining 105? This is what is cash received. You say this is the cash received. Because if you have not received this cash, your receivables should have been 130,000. So instead of 130,000 in your balance sheet, you've got receivables for only 25,000. So where is the remaining money? The remaining money you already have received. So cash received from customer is 105,000. The same way you will make cash paid to suppliers. How much are your purchases in this year? Then opening payables and closing payable. How much tax you have paid? Very simple question I ask you. Let's suppose that in your income statement, you say that my tax expense is $20,000. This is tax expense. How much actually have you paid tax? How much have you paid tax actually? This is expense. It does not say tax paid. Income statement, we always show expenses. We don't say how much we have paid. This is expense I've calculated that this is how much I should pay or this is my expense. But how much did you actually pay? It is not clear from here. Then I go to my statement of financial position and I say, okay, how much was last year? How much is this year? Tax liability. Tax liability. Oh, last year tax liability was 7,000. This year tax liability is 9,000. Then I say, fine. I have 7,000, my opening liability, opening tax liability. This year tax expense is 20,000. So it means that my total tax liability should have been 27,000. But I see only 9,000 here. So I say my closing liability, tax liability is 9,000. It should have been 27 because 7,000 was in the beginning of the year. 20,000 is current year. So total is 27. But balance sheet says only 9,000. So where is the difference? 18,000, you actually have tax paid. Okay, tax paid. This is what goes to cash flow. This is what goes to cash flow. This does not go to cash flow because this is not cash. This is cash. cash paid for the tax expense. So we use the statement of financial position. Two financial positions you need. You need opening, you need closing, and you take one number from P&L. So opening balance from the balance sheet plus or minus this income statement number, and then plus minus this balance sheet closing balance. Okay. So this is how we use the opening balances. A question could give you an opening statement of the financial position and ask you to work out initial receipts and payments from that. Then sales and purchases forecast will become relevant. For example, so let's see one very typical, example for such question. It says that statement of financial position extract at 31st December 2023, or you can call it 2013, whatever. Receivables 270 million, trade payable 120 million. So you have receivables. This is end of the year receivables. And trade payable are, of course, end of the year payables. Sales in 2003 were constant per month, and customers take 3 months credit. Suppliers are paid after 2 months. So customers are paying you in 3 months and suppliers are paying you after 2 months. So it means that this receivable and sales are constant, equal. Okay. You will always assume in questions that if you are given, let's suppose if I tell you that your annual sales are 12 million, you will assume that sales occur equally every year, which means that this 12 million is annual sale. So you will have 1 million sale per month. Okay. You will have 1 million sale per month. This is what we assume. We say that it is equal per year. Okay. So if you have this receivable of 270 million and customers and sales are constant, so it means that it says that customers pay 3 months. So it means that at any point in time, you have 3 months receivable. So this receivable is actually from 3 months of sales. So it means that 270 million divided by 3. So it is 90 million per month. So it is, if I'm supposing it at million. So it is 90, 90, 90. So this might be, for example, this is end of the year, 31st December. So it means that this 270 is the December sales, November sales, and October sales. Because October people have not paid yet. They will pay in January. So October, November, December, 90 plus 90 plus 90. So this is three months. Suppliers are paid after 2 months. If you have payables of 120 million, it means that this is 2 months of payable. So if I divide it with 2, my 60 million is November payable purchases. 60 million was December purchases. So November purchases I will pay in January. December I will pay in February, 60, 60. Okay. So these numbers you have to, you have to understand that if it says 270, what it includes inside. It includes 3 months, November, December, January, 90, 90, 90. It includes 2 months of payable, 2 months of purchases, November and December, 60 million and 60 million. So the question, it says that how much will be received from customers and paid to suppliers in January and February 2024. How much are you going to pay? Receive from customers and pay to suppliers. So what I need to do, I need to say receivables of 270 million represent 3 months, October, November, December. Therefore, 90 million per month, 270 by 3, will be received in January, February, and March. This will be received in January, February, and March, because October people 3-month finish in January. They will pay in January, they will pay in February, and December people will pay in March. This is 90, 90, 90. So if I have my January, February, and March, I'm going to receive 90 million from October, 90 million from November, and 90 million from December and March. Okay. And then payables of 120 represent 2 months, which means November and December purchases. Therefore, 60 million per month will be paid in January and February. So this much I have to pay. 60 I have to pay in January, and 60 I have to pay in February. This 60, it belongs to November. So I pay in 2 months. So December I will not pay, but January I have to pay. This is December purchases I will pay in February. So here my balance is 30 million. Here my balance is 30 million. This actually they did not ask in the question. The requirement was only how much will be paid in January and February. Okay, so dealing with cash shortages. Yeah, of course, when you will make a forecast, you will find out that next year in August, in the month of August, I have a cash shortage because some August is my prime season. I have to buy extra inventories from the market. My warehouse is full. My production is at full capacity, and I'm selling it to my customers. And customers' receivables have gone up. So in prime season, in peak season, you probably have cash shortages. So how do you deal with that? Postpone capital expenditure. We say, okay, in this period when we are cash shortage, we will not buy any equipment. Once the peak season is off, we will collect our cash and then we will buy our equipment. Try to accelerate inflows. For example, you start giving discounts so that you can collect more cash. Try to slow down or renegotiate payments. When I say slow down, it does not mean that you start annoying your suppliers. Okay, you need to renegotiate. If you are, I mean, you can normally you pay to your suppliers in 30 days, but you can renegotiate that during the peak season. I'm going to pay you not in 30 days, but in 60 days, in August, September, October, for example, or in July, August, September. Once my peak season will be off, I will start paying you in time. So you always have to talk and renegotiate, okay? Take longer credit, but don't upset suppliers. Do not upset your suppliers, okay? Otherwise, you will be out of your input materials. Renegotiate loan repayment with your banks or with other creditors. Reduce or postpone dividend payments. Don't make any dividend payments, wait for it. So when you have cash shortages, you need to handle with that. If nothing works out, or even if you apply all these and still you have cash shortage, then you are going for a loan. Then you go for a bank loan. Maybe liquidate inventory by having a sell off inventory. Try to sell surplus asset, for example, sell vehicles to a fleet management company and rent them back. This actually is a thing when you have long-term cash shortage. This is for long-term. This is not for the short-term. If you see that you're going to have a cash shortage for a longer period of time, and taking loan from a bank is like causing you extra interest, and you have some assets which are not used efficiently, which can be sold, then you sell them. But if you have short-term shortages, 3 months or 6 months, then you don't sell assets, okay? So you need to see that how much this shortage is there. Is it a short-term shortage or is it a long-term shortage? If it is short-term, you can go for a bank loan for 3 months, an overdraft facility. And then finance, reschedule loans, reduce dividends, raise loan, or equity finance if time allows. Okay, next session, we will do this cash flow forecast and uncertainty, very important topic. This we'll do in next sitting.